Hello and welcome to Sense Business YouTube channel. Today we will be covering 1.3.4 Sources of Business Finance. In this video or in this lesson we will learn short-term sources of finance, we will understand and know long-term business of finance, and we'll understand creditors and debtors, and then we'll understand external and internal finance. So what is finance, you might be thinking? Finance refers to sources of money for a business. As you can see, I've put loads of money images for you so that you are sure what it means, or if you remember what it means. The capital required to start or run a business. That is what basically finance is. It's the money that you need if you're a startup business to pay for your premises, new equipment. So equipment could be machines, desks, tables, laptops. These are all computers. These are all your equipments. In advertising, to pay Facebook, YouTube, Google to advertise for you, or to pay your local advertising agency to pay them to advertise for you. So you need finance to start a business. Then you need finance to run the business. So once you started a business, yay, great stuff. But you need finance, money to run that business. So having enough cash to pay for staff wages. So when you run a business, you need to have staff in there. If you have got a business where there's more than 2-3 people involved, so you need to have finance, money to pay wages. Even if you're working for yourself, you need to have some sort of money coming in. You need that money. If not, you'll not be able to survive. And then you need finance to pay suppliers on time. And then you might need finance to expand the business. So once you have started a business, great stuff, you have got everything, then you need the finance to run the business, great. Then when you want to expand your business, you need finance again. So having enough money to pay for new branch in a different city or a country. So finance is very, very important to a business. New businesses find it difficult to raise finance because they usually have just a few customers and many competitors. So lenders are put off by the risk that the startup may fail. If that happens, the owners may be unable to repay borrowed money. So that's why there are interest rates are so high, and not everybody is willing to help new businesses that are coming into the market. As you know, there might be a couple of adverts within this video. Don't get annoyed by them. If you don't like them, simply skip them. That's how I can afford to make a couple of pounds. Ways to finance a business. So that is short term. Short-term business finance enables businesses and financiers to seize quick business opportunities or deal with unexpected issues that require transactions to be completed in short time. The highlight of this kind of finance is its prompt availability to the businessman. So there are various types of short-term business finance. So number one is an overdraft facility. This is where a bank allows a firm to take out more money than it has in its bank account. I'm sure if you're over 18, you'll have a personal overdraft limit. Mine's 300 something. So everybody will have a personal overdraft limit, and it is also same for the business. So a business will also have an overdraft limit, which they can use that money to deal with unexpected issues or an opportunity that has arisen and they want to grab it. So trade credits, where suppliers deliver goods now and are willing to wait for a number of days before payment. So that is another great great way or a type of short-term finance, because you might not have money in hand, but you know that you could sell the goods that have been delivered to you within 2 days. So you could make a deal with the supplier and say, if you bring me all this stock, I'll sell it and then I'll give you money. There's lots of takeaways. Have a look at your local takeaways. They will they will all be on credit. So what will happen is they will bring all the dough, flour, pepperoni, ham, peppers, onions. They will bring everything to the shop on a Friday, and the supplier will not get paid until next Friday. So once the shop has made enough money, they would pay them the week after. And then that's how, so by the next Friday when they bring the new stock in, they will get paid for the last week of stock that they brought in. So money takeaways work like that. That's fast food. Restaurants work on that as well, where suppliers deliver goods and they get paid the week after. Factoring is another type of short-term business finance where firms sell their invoices to a factor such as a bank. They do this for some cash right away rather than waiting 28 days to be paid the full amount. Advantages and disadvantages of short-term finance. So they are quick funds when you are in need, available even to those with bad credit. The flexibility of repayments. Normally short term finance is one payment, you pay it back, and it's all done and dusted. However, the disadvantage is that it can be very, very high in interest rates. Ways to finance a business long term. Okay, so this is where funding's obtained for a time frame exceeding 1 year in duration. When a business borrows from a bank using long-term finance, it expects to pay back the loan over more than 1 year period. So whereas short-term is about 1, 2 days, 3 days, a week, a month, but long-term finance is about over a year. For example, this might include making a payment on a 20-year mortgage. So if you bought premises for your business, you obviously have a mortgage. So you'll be paying a regular mortgage for next 20 years. So that would be your long-term business finance. I've now got a PayPal account. So if you're liking these videos and you're really enjoying them, and if it's helping you a lot, please help me with a couple of pounds. If you can, just donate it into this link. I'll also put the link in the description below. So send me a couple of quids on PayPal if you're really enjoying these videos, because it would help me a lot and it will give me time to upload more and more videos for you guys. So various types of long-term business finance. So the long-term business finance can be owners who invest money in the business. For solo traders and partners, this can be their savings. For companies, the fundings invested by shareholders is called share capital. Loans from a bank or from family and friends. Debenture are loans made to a company. This is a long-term security yielding a fixed rate of interest issued by a company and secured against assets. A mortgage, like I explained earlier, which is a special type of loan for buying property where monthly payments are spread over a number of years. Hire purchase or leasing, where monthly payments are made for use of equipment such as car. Leased equipment is rented and not owned by the firm. So you need to, when you lease something, you're simply renting it. You're not owning the item or the equipment. However, hired equipment is owned by a firm or a business after the final payment. So if you have hired a car, you might, after you have made your last payment, the equipment is yours. Grants from charities or the government to help businesses get started, especially in areas of high unemployment. So if there's an area that has very high level of unemployment, charities and government might offer to give you some money for a long term where you can start up a business and get the local community moving, getting jobs of making jobs available for everybody and getting the boosting the economy in that little community. So advantages of long-term finance is that it is stability. Long-term financing provides businesses and individuals with a more stable debt management instrument than a short-term loan. Another good thing about long-term finance is the flexibility. There are a wide variety of long-term debt financing options available to borrowers, such as mortgage, leases, reverse mortgages, and loan refinancing, which can be fine-tuned to meet the borrower's needs. Low maintenance and monitoring costs. In contrast to short-term loans, such as credit from a supplier, which changes over time and requires regular monitoring. Long-term financing is regular and structured. Hey, the disadvantage of long-term finance. There's disadvantages to everything in life, and so there is to long-term finance as well. The interest rates available for a long-term financing agreement are usually higher than the rates available for shorter loans. Greater interest cost because you're renting the money for a longer period of time, so you're paying interest on it for a longer period of time, so you'll have to pay a lot of money. For example, if you was to buy a house for 100,000 and you'd probably end up paying 130,000 or 140,000 to the bank after to be able to have the property under your name if it's a mortgage. So there will be like 40,000 interest you'll pay over 20 years. So that is the disadvantage. Debt is the most risky source of long-term financing. Let's understand what creditors and debtors are. A creditor is an individual or business that has lent funds to a business and is owed money. A debtor is an individual or business who has borrowed funds from a business and so owes it money. There is a cost in borrowing funds. Money borrowed from creditor is paid back over time, usually within an additional payment of interest, like I said earlier about the mortgage. Interest is the cost of borrowing and the reward for lending. So this is the creditor. If he lends his money to the debtor, he will have to pay him back something for taking the risk to borrow the money to him. So if he borrowed this guy £1,000, he might have to pay 1,100 to this guy after an agreed time. Creditors often ask for security before lending funds. This means solo traders and partners may have to offer their own house as a guarantee that monies will be repaid. A company can offer assets, offices as a collateral. So this means if a bank is not willing to give you a money for your word, then you can offer your house as a guarantee, or your business, your laptops, your machine. So these are your assets. You could offer the bank as a guarantee to say that if I don't pay, you can have these things and what have you. The type of finance chosen depends on the type of the business. Startups and small firms are considered very high risk and find it difficult to raise external finance. The only source of funds might be the owner's own saving. retained profit, and borrowing from friends. Companies can issue extra shares to raise large amounts of capital in a rights issue. So let's understand what some external and internal sources of finance. So internal sources of finance can be your personal savings, retained profits, share capital invested by the founder. External could be bank loans, a bank overdraft, share capital, outside investors. So these are different types of internal and external sources of finance. And that brings us to the question time. I would like you to please comment in the section below answer to these questions, because it would be pointless you watching these videos if you do not understand the key point. So I'd like you to list 2 sources of short-term finance available to a business, list 2 sources of long-term finance available to a business, explain the difference between creditors and debtors, list 1 advantage of short-term finance and 1 disadvantage of long-term finance. Please make sure you answer these questions in the section below. Also, make sure you subscribe to this channel, like and share, as you know, and make sure if you have got a spare couple of quids, you send them over on that PayPal link below. Thank you very much, and I'll see you on next video.